We've had an amazing recovery in the S&P 500. It's been absolutely historic. In fact, this recovery is the fastest market recovery in history. It only took 11 days for us to come back from the lows. Only 11 days. The dot-com crash took 1,166 days. Even the tariffs last year took 55 days. This one recovered in 11 days. It's been absolutely historic. If you guys remember, I was doing a lot of bullish videos back then and saying why it's not gonna be as bad as a lot of people thought it would be. A lot of you guys benefited from those videos and it helped you out. And a lot of people call me a perma bull. And I'm not really a perma bull, but I'm more about looking at where we are in the cycle and looking at the sentiment in general. I believe the sentiment right now is extremely euphoric. I believe the market is setting up for a blow-off top phase where we keep on going up and more people see other people getting rich in semiconductors. They throw in the towel on their stocks and they get into semiconductors because they can't take seeing their neighbors getting rich, and they sell their stock and buy more semiconductors and buy more AI until we have a blow-off top. And it's normally a sharp drawdown. Even your stop losses are not going to save you if you're trading them and you're not really holding them long term. And I'm also seeing a catalyst that could cause this to happen. So it's not just because stocks are too high. I'm actually seeing a catalyst. And I'm going to talk about all of this today. And I really hope you enjoy it as always. Now, if you look at the tech ETF or the tech sector in general, it went up 20% on the month. 20% on the month. The last time the tech sector has gone up 20% on the month, it happened in 1999, before the peak, and it happened before the 1929 depression and stock market crash. The sentiment, without a doubt, is extremely euphoric. You have many analysts on CNBC and even on Twitter saying the bull market could continue on forever. Why? Because we have AI, and AI is going to change the world, and this is going to change the world. And I've seen this so many times, guys, where the market is not really efficient. There's no equilibrium in the market. The market always gets more pessimistic than it should, and it gets more optimistic than it should. This is why we have such massive rebounds and massive crashes. This is why we have volatility, because the market never gets it just right. It's either extremely optimistic more than what the actual reality is, or it's extremely pessimistic. Like in 2021, we had a massive rally fueled by Tesla because EVs are going to take over the world and climate change and all of that. After Tesla, you had NIO. After NIO, you had Beyond Meat, which was a garbage company, but again, it was climate change, clean, everything is clean or whatever. And after Beyond Meat, it had something else. And after this one, we had something else. And we kind of had the similar thing. I'm not saying this is 1999. I think it's similar, much more similar to 2021. Now, if you look at the S&P 500 percentage of options, 60% of every option is actually a call option. So that hasn't been seen in a while. Pretty much not, since like 2015, 2016, where 60% of every option on the S&P 500 is actually a call option. So I'm not seeing a lot of bearish people right now. I'm only seeing bullish content on YouTube and especially on X. Now, if you look at the semiconductor ETF, the SOX related index, it's the most overbought it was since 1999. The RSI on this thing is 85. 85 RSI. This is extremely overbought. This is like extreme territories, and it only happens once every 10, 15, 20 years. And this is again on the monthly. So it's again, it's really, you could say, crazy, the kind of euphoria that we have at the moment. And this is something that Warren Buffett said. He said, speculation is most dangerous when it looks the easiest. So if you look at what we had over the last week, 2 weeks, we had some easy money being made. Like if you bought any AI, any semiconductor stock, if it has AI, semiconductor, data center, anything around it, and you buy the stock, you don't even have to wait a few months or for the earnings report and the market realize the value, stock goes up, and you feel like a genius. And it was, again, easy to speculate on those things. It was kind of the same thing in 2021, and people were speculating anything has to do with climate change, clean energy, plant-based stuff, clean, anything that has to do with this theme. Easy money, you made a lot of money. And the problem is that people bought them at the wrong time, after the early people bought them and they lost their shirt on them in 2022, which is another quote from Warren Buffett saying what the wise man does in the beginning, the fool does in the end. And again, I'm not saying no stocks can't go up over the next few years. I'm not saying they're like crazy overvalued, but in terms of the sentiment and the setup, to me, it looks really, really obvious. And I'm not a technical person, but if you look at the technicals in general, we're getting pretty close to a major resistance line. And I think there's an event that's going to dictate what happens once we get closer to this resistant lines. And this event is mainly the new Fed chairman, Kevin Warsh. Kevin Warsh is kind of known for being for lower interest rates. So he wants to cut interest rates, but he also wants to do so many changes at the Fed. And this is what's driving me crazy about this market, is that it's getting so overbought. And then you have a Fed chairman that's coming in next month. His first meeting is next month. He wants to change the Fed. He wants to change so many different things. And the market is not caring. The market doesn't normally like changes. The market likes predictability. Powell was predictable. He doesn't like to surprise the market. This guy is completely different. He's even saying that QE is reverse Robin Hood, and it's policy that steals from the poor and gives to the rich. Now, this is a really, really big problem, because QE is what really drives M2 money supply. And M2 money supply in the yellow ultimately gets liquidity. It goes in the economy, and it drives the companies and the S&P 500 in the yellow much higher, and the M2 is the white one. But there's a big correlation between M2 money and the S&P 500, and there's a big correlation between the Fed balance sheet, or QE, expansion of liquidity, versus the S&P 500. And the market is not caring about it. But I think the biggest one that the market is not caring about is mainly around forward guidance. So the Fed does something called a dot plot. This dot plot is published every quarter, every 3 months, and it's mainly a chart that gives guidance based on what FOMC members believe is the appropriate rate for the Fed, or the appropriate federal funds rate for a specific year. For example, in 2026, you have a lot of dots on 3.2 to 3.5. So this is where they believe the appropriate rate should be. In 2027, most of them believe the appropriate rate is like 3 to 3.25. 2028, you have one longer run. You also have one where you have most of the dots at a specific line, and you can kind of tell what kind of rates are they seeing over the long term. Now, that's really important for the bond market, especially longer term yields like the 30-year. It's almost sitting at 5%. We had this crazy rally, and you have the 30-year at 5%. You have the 10-year, which the government doesn't have a lot of control over, is sitting at 4.3%. If you remove forward guidance, what's going to happen to the bond market? What's going to happen to future expectation, to the discount rate in general? This is a really big one. And this is a massive, massive change that the market is not used to. We had forward guidance for years and years and years, and he wants to get rid of it. So that could be a major, major catalyst for the market in general. And the meeting is June 16 to June 17. So I believe this meeting will dictate everything. If he comes out extremely, extremely dovish, I believe we will likely break out of this trend line, and it's really gonna be like party 1999 or party like it's 2021. And I believe the rally will likely broaden out. So it's not going to just be semiconductors. It's going to be like in 2021, where it started with EV stocks, but then people started finding the next one. So they started, even anything went up. Celsius went up. Any kind of a growth stock, SPAC, started going up. We even have some IPOs coming up. Like this is a big one coming up next week. We have the SpaceX IPO coming up. I believe Andrew is coming up, and Anthropic's coming up, OpenAI is coming up. So that could be a potential 2021 scenario where we have a broadening of the rally, and we have a more distribution, and the index and everything goes much, much higher. If that happens, I'm personally going to be a seller. I'm going to be selling a lot of the stocks that I own if they get extremely overvalued. I did that in 2021, and I bought British American Tobacco and a lot of just dirt cheap value stocks. And in 2022, I made a 27% return. If that happens again, I'm going to be a seller of a lot of the overvalued stocks. And that has a good chance to happen if he comes out dovish in general. If he comes out hawkish and if he brings in uncertainty to the market in general, I believe this trend line will likely act as resistance. and we could have the kind of blow off tops that I showed you in the beginning happen much earlier. And then I think after we have this pullback, then we could have a broader rally in general. Because if you look at what we have right now, we don't have a broad rally. We mainly have an AI semiconductor rally. And if you don't own semiconductors or AI or data centers, you're pretty much left out. And I've never seen such a divergence in my life. Like we used to say, okay, I want to bet on a recovery, so I'm going to buy growth. I'm buying growth stocks, because all of them used to go up together and they go down together. Especially, for example, Robinhood stock, which is a broker people trade on. They're trading on it on this euphoria, but Robinhood is not going up. So I've never seen such a divergence before. The way I believe it's going to play out is if he comes out extremely dovish, we're likely going to break out, party like it's 1999 or party like it's 2021, a broadening of the rally. If that doesn't happen, then I think it could potentially act as a major resistance, and we could potentially reverse from it. Now, I just want to reiterate again that I'm not really bearish on the S&P long term. I believe, the P is like 21, although a lot of those companies are a little bit more than 21, especially in the AI-related stuff. But the P is not too high, so earnings is not too bad, really. But we're pricing in, again, an improvement in earnings where earnings revisions have been getting revised much, much higher, and that's really helping the rally. So I don't believe a lot of stocks are overvalued. I don't believe the S&P is overvalued, but I believe in terms of a risk to reward setup on how overbought the semiconductors are relative to the sentiment in the market and relative to some expectations, again, where they're being priced at the best case scenario and like nothing could go wrong or anything could happen. I believe there's more risk than reward. And I personally have seen those patterns before, and I believe this is the most likely setup. But we'll see what happens. I'm going to be watching for the Fed meeting in June, see what Kevin Moore says. If he's too dovish, I think we could have a major broadening of the rally, and everything else could participate as people look for the next big thing, and you have the IPOs, and you have all of that. But if that doesn't happen, I personally believe we could have a major reversal. So that's my opinion on the market. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.